Hello everyone. Good afternoon, students. How are you all doing? So today we are going to continue further. Are you guys ready? Okay. So let us continue now with your ratio analysis. Okay. And now we'll be starting with our next question. Okay. So guys, we completed your question number 8. Okay. Where we discussed what is the meaning of your works cost and how do we calculate the works cost by taking into consideration whatever is going to be your breakup of your cost, right? So now we are going to continue further and we are going to deal with your next question. Okay, let's start with your question number 9. Okay, chalo. Ganpati Limited has furnished the following ratios and information relating to the year ended 31st March 2020. And what do you have here? You have sales amounting to rupees 60 lakhs. We have return on net worth, which is nothing but your 25%. We have rate of income tax, that is 50%. Then we have the share capital to reserves, which is 7 is to 3. Then we have the current ratio, which is 2 is to 1. And then we have the net profit to sales, which is 6.25. Inventory turnover ratio, which is based on your cost of goods sold, that is nothing but 12 times. And the cost of goods sold is 18 lakhs. Interest on debentures is 60,000. Receivables is 2 lakhs. And payables is nothing but 2 lakhs. So we are required to now calculate what is going to be the operating expenses for the year ended 31st March 2020. Then we are also required to prepare the balance sheet as of 31st March in the following format. So they have given to you the format. Okay. So the best part is in this particular question, do we have the face of your balance sheet available? Come on, yes or no? Yes, sir. We have the face of the balance sheet available. So what do we have to do? We just have to calculate the figures and then we have to substitute in this particular balance sheet. Okay. Now, my dear students, how are we going to approach this particular question? See, guys, the first thing they have asked you is that we are required to calculate what should be your operating expenses. That's the first part of the question. Now, to prepare the operating expenses, what do we need to do? We have to actually prepare the entire income statement. We have to prepare the income statement in such a way we will be starting with sales. From sales, we'll be subtracting COGS, we'll be getting gross profits. From the gross profits, then we'll be subtracting whatever is going to be the operating expenses, we'll be getting EBIT. Then we subtract interest, we'll be getting EBT. Then from that, we'll be subtracting tax, we'll be getting N. Okay, so this is the format of the income statement. And the first thing they have asked you is, we are required to calculate what should be your operating expenses. So now, to calculate this particular operating expense, we have to definitely prepare your income statement. Okay? Because in this particular question, we have sales also available. We'll be having COGS also available. Then we are going to have your net profits also. So we have all these things available. So we just have to simply prepare the income statement to calculate what should be your amount of your operating expenses. Okay? So let's start with your question number 9. You can go to your notebooks and write down A part, calculation of operating expenses. Now, how are we going to continue further calculation of operating expenses? We'll be first preparing the income statement format. We'll be starting with your sales. From sales, we'll be subtracting your COGS. We'll be getting your gross profits. And then, my dear students, from your gross profits, we need to now subtract what is going to be your operating expenses. And then we'll be getting something which is called as your operating profits, which is also known as your EBIT. And then guys, from the amount of EBIT, what do we subtract first? So we are going to now subtract first your interest element. Then we'll be getting your EBT, from which we'll be subtracting your tax. And what is the tax rate which is given to you? The tax rate which is given to you, that is 50%. So that will be your net profits after tax. And is there any preference dividend in this question? Then the answer is absolutely no. There is no preference dividend. So can I put it like this, that all the profits actually belongs to whom? They belong to the equity shareholders. Come on, yes or no? Yes, sir. So this will be nothing but net profits for equity shareholders. Correct? So this is the basic format of our income statement. Come on, yes or no? Yes, sir. We prepare it like this by taking sales less COGS, GP, operating expenses, EBIT. From that we subtract interest, we get EBT. From that we subtract tax at the rate of 50%. Then we'll be getting NPAT, and then we'll be getting net profit for equity shareholders. This is the standard format of our income statement, which we have discussed in the earlier lectures. Okay. Now, my dear students, we have to calculate in this particular question what should be your amount of operating expenses. So this will now be our balancing figure. How will we start? So are we going to have any sales in the question? Come on, yes or no? Yes, we are having sales, which is 60 lakhs. And then, my dear students, we are going to now have COGS, which is amounting to rupees 18 lakhs. So we have COGS 18 lakhs. So this will now give me the amount of the gross profits, that is 42 lakhs. And then what about my operating expenses? So you guys can just check, that is the balancing figure. That is something which we need to calculate it. Guys, we have something which is called as your interest on debentures readily given, and that is 60,000. So we will now write down here interest, which is 60,000. And if you guys can just check, there is something which is called as net profit to sales. Oh, so in this particular question, do you have the net profit ratio available? Come on, yes or no? Yes, sir. So what is your net profit ratio? Your net profit ratio is nothing but NPAT upon sales into 100. So we are having a net profit ratio of 6.25%. So what needs to be done? We are having the sales of 60 lakhs. So from 60 lakhs, we will multiply that by 6.25%. So from 60 lakhs, I need to multiply 6.25%. I'll be getting 3,75,000. So is 3,75,000 my net profit for equity shareholders? Come on, yes or no? Absolutely yes. What we need to do next? Now we can go reverse to calculate what should be your EBT, what should be your tax, and then we can calculate your EBIT and ultimately what is going to be the operating expenses. So what we need to do? We just need to go reverse. So if EBT is 100, tax is 50, so NPAT is going to be 50. Do you all agree with this? Okay. So EBT minus tax, that is going to give you NPAT, and NPAT we already have, that is 3,75,000. Can we cross multiply and can we calculate your amount of EBT? Come on, yes or no? Yes, sir. So if 50 figure is 3,75,000, your 100 figure should be how much? We can cross multiply it. So we can take 3,75,000, multiply that by 100, divide that by 50, that will give you 7,50,000. So now this will be 3,75,000. And now, my dear students, if this is 7,50,000, this is 60,000. Can I say now this figure will be 8,10,000? Come on, yes or no? Yes, sir. And from this 42 lakhs, we need to subtract 8 lakh 10,000. What do we get as our operating expenses? 33 lakh 90,000. Guys, very simple and easy to understand. That's how we'll be getting 33 lakh 90,000, which will be our operating expenses. So the process here is extremely simple. What we need to do is we have to prepare the income statement by taking sales less COGS. We'll be getting gross profits less operating expenses, EBIT less interest, EBT less tax. We'll be getting NPAT or net profits for equity shareholders. Then, my dear students, we just need to go reverse, calculate the amount of operating expenses, which turns out to be 33 lakh 90,000 rupees. I hope you all are comfortable at least till this much part. Continuing further, in the second part, we are actually required to prepare the balance sheet as on 31st of March. Now, how are we going to prepare the balance sheet? So, as I've told you that from the ratios, if you have to prepare the balance sheet, what do we need to do? We have to compulsory prepare the face first. So, are we going to prepare the face first? Come on, yes or no? Yes, sir. So, we have the face of the balance sheet. In that, we have share capital, we have reserves, we have 15% debentures, we have creditors. On the asset side, we have fixed assets, current assets, stock, receivables, and cash. So, what we need to do, we just have to prepare this face first with the help of the ratios. Then, are we going to prepare and complete the balance sheet? Come on, yes or no? Yes, sir. So, now you all can write down B part. Balance sheet as on 31st of March 20. So, let us prepare the face of the balance sheet first, in which there will be items like the first item which we have here is your share capital, so also known as your equity share capital. Then, my dear students, what do we have next? We have reserves and surplus, so we can write down here reserves and surplus. And the total of this will be called as equity shareholder funds, which is also known as your net worth. And then, my dear students, what's the next thing which we have here is your 15% debentures. So I can write down here 15% debentures. And then what do we have next is your payables. So that will be your current liabilities. So in your current liabilities, the next thing which we are going to have will be called as your payables. Correct? On the asset side, now which all things are we going to have? So do we have fixed assets? Yes, we do have fixed assets. And then, my dear students, we have the list of current assets as well. So we have current assets. And in current assets, we have number one, stock. Number two, receivables. And number three, what do we have? We have cash. So we are ready now with the face of the balance sheet. Okay, so once we are ready with the face of the balance sheet, what is the next thing we are going to do? Now let us substitute the figures which are readily available, right? So it becomes easier for us to solve. Which figures are readily available? You guys can just check. Here we have receivables amounting to 2 lakhs. Okay, very good. So we have receivables. So I can write down here receivables, which is nothing but 2 lakh rupees. Then, my dear students, this is given to you. So as a standard practice, guys, there are no shortcuts to success. We have to do everything very thoroughly, very systematically, one step at a time. And the presentation part is extremely important. How do we present these particular ratios? How do we prepare the balance sheets, financial statements, etc.? Extremely important. Okay. Because as I told you earlier also, we are not going to give even a single percent chance for the examiner to cut our marks. Okay. Now, what is the payables? The payables which is available, that is nothing but 2 lakhs. So your payables, this is also given to you. Okay. And then we have something which is called as return on net worth available. Okay, so if you can just check this particular ratio, we have return on net worth, which is nothing but 25%. Now, my dear students, if you have return on net worth available, can we calculate what is going to be your net profits for equity shareholders? With the help of that, we are now going to calculate your equity shareholders funds. So how are we going to calculate this return on net worth? Okay, so we will now write down here working note number 1, and you can give the heading here return on net worth. And as my dear students, you all know return on net worth is nothing but your return on equity shareholders funds, right? So this return on equity shareholders funds, how are we going to calculate it? So return on equity shareholder funds, that is nothing but net profits available for equity shareholders, which we divided by equity shareholder funds into 100. Will this give you a return on equity shareholders funds? Come on, yes or no? Yes, sir. Now, what is this return percentage which is given to you? The return percentage given to you is 25%. So we have this as 25. Do you have the net profits for equity shareholders? Yes, sir, we do have it. How much is that? 3,75,000. So that is your net profit for equity shareholders, 3,75,000. Let this be X. So based on this, I'll be getting my equity shareholders funds, that will be 3,75,000 into 25, divide that by 100. Sorry, 3,75,000, divide that by 25 into 100, that will give you 15 lakhs. So now do I have my equity shareholder funds, which is nothing but 15 lakhs? Come on, yes or no? Yes, sir. We have now our equity shareholders funds, which is nothing but 15 lakhs. So which means that your net worth is available. So are we in position to now substitute that in your balance sheet liability side? Come on, yes or no? Answer is absolutely yes. So you know what we have to do? We have to simply take this 15 lakh rupees and substitute here as your net worth 15 lakhs, and this actually comes from your working note number 1. Step by step, process by process. So we are now going to have your net worth, which is nothing but 15 lakhs. And also, let us continue further now. The next thing they have given to you rate of income tax, which you have already taken into consideration. Guys, there is something which is called as your share capital to reserves. Now, share capital to reserves, do you have breakup available? Come on, yes or no? Yes, sir. We have the breakup of share capital to reserves. And that is nothing but 7:3. So we have equity share capital of 7. We have reserves of 3. So this is nothing but 7 by 10, 3 by 10. Do you guys agree with this? 7 by 10, 3 by 10. So now 15 lakhs, if I divide that by 10 into 7, so this will be nothing but 10 lakh 50,000. And the balancing part, okay, will be nothing but 4,50,000. So is this your bifurcation of your equity share capital and your reserves and surplus? Come on, yes or no? Absolutely yes. This is how we are going to calculate equity share capital, reserves and surplus. Equity share capital is 10,50,000, reserve and surplus is 4 lakh. Okay, the total of this is nothing but 15 lakhs. Then what's the next thing which we have? We have something which is called as your current ratio. Can I use my current ratio? Of course, yes, I can use my current ratio. You know why? Because you guys can just check that we have the payables amounting to rupees 2 lakhs. Now, if we have the payables amounting to rupees 2 lakhs, with the help of this payables, which is nothing but your current liabilities, can't I calculate what is going to be my current assets? Come on, yes or no? Of course, yes. And we also have the ratio available. So you all know what's your current ratio. Your current ratio is current assets upon current liabilities. Okay. So now we are going to start with your working note number 2. And you can give the heading current ratio. Now, what is going to be your current ratio formula? So as you all are aware, your current ratio is nothing but current assets upon current liabilities. And how much is this particular ratio? Guys, this ratio is nothing but They have given to you 2:1. Wow. So we have current ratio of 2. What is the current assets? We don't have it. But guys, do we have the total of the current liabilities? Come on, yes or no? Yes, we do have the total of the current liabilities, which is nothing but your payables, that is 2 lakh rupees. So now I have current liabilities also amounting to rupees 2 lakhs. So this will now help me to calculate the current assets, which will be nothing but 4 lakhs. So do I have the total of current assets also available? Come on, yes or no? Yes, sir. The total of current assets is nothing but now 4 lakh rupees. So I can substitute that 4 lakhs here and give the reference to working note number 2. Okay, guys. So with this, can I say my total of current liabilities taken into consideration, total of current assets I've taken into consideration. So now you can just put a tick mark to your current ratio. Your net profits is also we have taken into consideration. Now we have something which is called as inventory turnover, which is based on cost of goods sold. Are even if they would not have mentioned, can I say your stock turnover ratio is based on cost of goods sold only? Come on, yes or no? Yes, sir. So how do we calculate your stock turnover ratio? It's nothing but COGS upon average stock. But my dear students, we are not going to use the word average here. We are going to simply use the word closing here. Why? Because there is no opening stock available. And when the opening stock is not available, we have discussed this quite a number of times that your opening is same as your closing and that itself will become your average. All right. So in this particular case, what will be your stock turnover ratio? So stock turnover ratio will be nothing but COGS upon closing stock. And my dear students, what is the turnover ratio which they have given to you in the question? The turnover ratio which they have given to you in the question is nothing but 12 times. So my dear students, we have the turnover ratio as 12 times. So I will write down here 12. What is the amount of COGS which we have? The amount of COGS which we have is nothing but 18 lakhs. And guys, let the closing stock be X. Now this data is sufficient for you to calculate what is going to be your stock amount. So that will be 18 lakhs, divide that by 12. So that will be 1,50,000. So now do we have the amount of stock also available? Come on, yes or no? Yes, sir. That is 1,50,000 and this 1,50,000 can come here, which is your stock 1,50,000. So automatically we'll be getting the cash, which will be 50,000. Are you all convinced with this much part? Okay, so we have now your balancing figure also available. We have cash also available. So ultimately we have the breakup of current assets. We have the breakup of current liabilities. All these things we have now completed it. Continuing further, what do we have next? Okay, we have interest on debentures, which is 60,000. Now, my dear students, the interest on debentures is 60,000. And we have the rate also available, which is 15% debentures. Don't you think, guys, if I have the interest amount available and if I have the rate available, we can calculate what is going to be the total value of the debentures? Come on, yes or no? Of course, yes, we can calculate it. So what are we going to do? So now we'll be starting with your fourth part, and that is nothing but calculation of debtors. How, how will you calculate your debentures? Sorry, not debtors, calculation of debentures. How will you calculate this? If on 100 rupees, your interest is 15. Now also at the same time, please check, do you have the amount of the interest available? Yes, sir. What is the amount of the interest which is available? So we have just now checked the amount of the interest which is available, that is nothing, 60,000 rupees. So in that particular case, if I have the amount of the interest available as 60,000, can I calculate what is going to be my principal amount? Yes, I can. So 60,000 into 100, divide that by 15, that will give you 4 lakhs. So is 4 lakhs going to be your amount of debentures? Come on, yes or no? Yes, sir. So actually I've taught you now how do you calculate the amount of the debentures when the interest rate is given to you and the interest amount is given to you. So that is something which is also called as the process of capitalization, where we take on the face value 100, this is the amount of interest. So interest percentage, we can cross multiply it and we can definitely get the amount of debentures which appears to be your 4 lakhs. What to do with the same? Can I go and substitute that in the balance sheet? Come on, yes or no? Yes, sir. So let us now go to the balance sheet and write down here debentures, which is now going to be 4 lakhs. And I hope my dear students here have realized with the help of this, I know that now my total of liability side is 21 lakhs. And if my total of liability side is 21 lakhs, what is going to be my total of assets? That is also going to be 21 lakhs. And if this is 4 lakhs, can I say the fixed assets amount is going to be 17 lakhs? So my dear students, this is our focus. What are we going to do? Very logically, each and every step, each and every question, we are going to solve it, in the most detailed manner. And I want you all to do these questions along with me. And genuinely, if you are able to solve all these questions around, along with me, and if you are able to do it properly, then no one can really touch you in your ratio analysis. Okay. If question will come in the examination, then you're definitely going to crack it very well. Okay. So with this, my dear students, we are done with your operating expenses. We are done with your balance sheet. The entire question is now completed. Okay. So question number 9 is now over. Now let us start with your question number 10. Okay. Let's start with this question number 10. Okay. I think there is some problem with, let me just check. Okay. Chalo. Now we are in the position to start with the next question. Okay. And I want you all to please come to your question number 10. First, let's read what is given in the question. Using the following information, we are required to complete this particular balance sheet. Now, again, the format is given to you, but see, they have given to you format in a very weird way. We have long-term debt to net worth, which is given to you as 0.5 to 1. We have total asset turnover ratio, which is given to you as 2.5 times. Then we have the average collection period, also known as a debt collection period, which is 18 days. And they have also told you here that assume 360 days a year and all sales are on credit basis. Inventory turnover ratio is 9x. 9x means it's 9 times. And then we have the gross margin, which is 10%, and we have asset test ratio of 1:1. What is asset test ratio? So I've explained to you earlier, this is also nothing but your quick ratio. Then we are having cash, account receivable, inventory, plant and equipment, total assets. So total assets, which should actually appear on the balance sheet asset side, we usually write it on the right hand side. Here they have given to you here in this particular format. And then they have told you it's notes and payables, long-term debt, common stock. Common stock actually means equity share capital. So common stock is also known as ordinary stock. So equity share capital is actually called as your common stock. And then we have retained earnings, which is 1 lakh, and this is total liabilities and equity. So now based on this particular information, we are required to prepare the entire balance sheet where there will be total, there will be common stock, then there will be reserves and surplus. The total of that will be called as your equity shareholders funds. After that, we are going to take into consideration long-term loans. And then we are going to have your current liabilities in which there will be notes and payables, that is creditors. On the asset side, then we'll be having plant and equipments. And on the current asset side, we'll be having cash, receivables and inventory. So this entire format, we need to prepare it. So we will just reshuffle this in the format which we want. Okay. So now I want every one of you to please come to your question number 10 and let us write down here Messrs. We don't know what is it. Balance sheet as on. They have not given to you which particular date. And let us now first prepare the face. So while preparing the face of your balance sheet, we'll be having, first of all, on the liability side, something which is called as your common stock. So I'll use the same word common stock. But as you all are aware, this common stock is also known as your equity share capital. And guys, do you have the amount of equity share capital? Come on, yes or no? Yes, sir. We do have it. Your equity share capital is nothing but 1 lakh rupees. So we have this as 1 lakh. And then, my dear students, we have retained earnings. So we have reserves and surplus, or else retained earnings. And that amount will be nothing but again 1 lakh rupees. Can I say the total of this will be actually called as your equity shareholders funds, which is also known as your net worth. So we have this as equity shareholders funds or net worth, which is 11 lakhs. And then what do we have next? So we have long-term debt. We have your long-term debt. And then we have something which is called as notes and payables, which is your current liabilities. So we have current liabilities. In that we have notes and payables. And do I have the amount of the same? Come on, yes or no? Yes, sir. What is the amount of your notes and payables? That is nothing but 1 lakh rupees. Okay. What about the asset side? On the asset side, we have first plant and equipment for which the figure is not available. And then, my dear students, we are going to have some current assets. So what are the list of current assets which we have? So we have the list of current assets in which there is debtors, stock and cash. So first I'll write down cash. Then the next one is your account receivable, also known as your debtors. And then there will be stock. Okay, guys. And do we have any of these figures available till now? No, sir. Not readily available. But let us figure it out with the help of ratios. How can we calculate the same? So the first thing which you have is very simple. That is long-term debt to net worth. At least I can start with this particular ratio, long-term debt to net worth. So long-term debt to net worth. Guys, this is nothing but your debt equity ratio only. Debt upon equity shareholders funds. Will that give you your debt equity ratio? Come on, yes or no? Yes, sir. So now, my dear students, we are having long-term debt to net worth. And what is this particular ratio? The ratio of 0.5 is to 1. So your long-term debt, let that be X. What is your net worth? 11 lakhs is equal to 0.5 upon 1. So now what is going to be your X? So that will be 11 lakh into 0.5, which is nothing but 5 lakh 50,000. So that is going to be my long-term debt. And with the help of this, we can very easily now complete your balance sheet total liability side, which will be 11 lakhs plus 5 lakh 50 plus 1 lakh. That will be nothing but 17 lakh 50,000. So this will also be 17 lakh 50,000. Now, my dear students, what do we have next? So we have something which is called as now total asset turnover ratio. Acha, can I calculate my total asset turnover ratio? Come on, yes or no? Yes, sir. We can calculate your total asset turnover ratio. And how are we going to calculate the same? So working note number 2, total asset turnover ratio. The formula for this is sales upon total assets. Sales upon total assets. So total asset turnover ratio, guys, what is your total asset turnover ratio? Here it is 2.5. Let the sales be X. And do you have the amount of the total assets available? Come on, yes or no? Yes, that is 17 lakh 50. So is this data sufficient for you to calculate the amount of the sales? Yes, sir, it is sufficient. 7.5, 17 lakh 50,000 into 2.5. So that will be nothing but 43 lakh 75,000. So do I have the amount of sales also available? Come on, yes or no? Yes, sir. I have the amount of the sales available. Now in this particular case, your total asset turnover ratio is 2.5 times. We have got the amount of the sales. Your average collection period is 18 days. This data will actually help you to calculate what is going to be the amount of the debtors. So this will help you to calculate what? What is going to be the amount of what? Amount of debtors. So what is going to be the formula for debt collection period? So I would say that the debt collection period is nothing but 1252 or 365. Here they have told you to consider 360. So I'll be taking 360 and dividing the same with your debtors turnover ratio. So this will now be 360 upon, what is the formula for debtors turnover ratio? Your debtors turnover ratio is nothing but your credit sales upon your average debtors. So that is nothing but, can I say average debtors upon credit sales into 360. And do I have the debt collection period available? Come on, yes or no? Yes, I do have it. What is the debt collection period? It is 18 days. So I have this as 18 days. 18 is equal to. Now I don't have any opening debtors available. And guys, when the opening debtors is not available, can I say we are going to continue that with the closing debtors only? Come on, yes or no? Yes, sir. And what is the amount of the credit sales? The amount of the credit sales which we just now calculated is 43 lakh 75,000. So this data is sufficient to find out what should be the amount of your closing debtors. So that is 43 lakh 75,000 into 80, divide that by 360. So that is 2 lakh 18,750. So do I have the amount of your debtors? Come on, yes or no? Yes, sir. 2 lakh 18,750. What will I do with the same? I'll substitute here 2 lakh 18,750. And this actually comes from your working note number 3. So your debtors is also done. Now let's talk about stock turnover ratio, which they have told you, which is nothing but 9x, 9 times. So my dear students, now we are required to calculate the stock turnover ratio. How will you calculate the stock turnover ratio? So we have already learned this. Your stock turnover ratio will be nothing but COGS upon average stock. COGS upon average stock. So what is the stock turnover ratio which is there? You have a stock turnover ratio of 9x, 9 times. Sales minus GP can give you your COGS. And by any chance, you don't have the opening stock of finished goods. So if opening stock is not given to you, can I say I can replace this average stock with your closing stock? Come on, yes or no? Then the answer is yes. So what's my stock turnover ratio? 9. What's the amount of my sales? The amount of my sales which I just now calculated is nothing but 43,75,000. And GP is how much percentage? So GP is nothing but 10%. So now this will be 43,75,000 minus 10%. Divide that by 9. 4,37,500. 4,37,500. So now, my dear students, this 4,37,500, I can go and I can substitute here 4,37,500. Okay. So with this, is my amount of the stock also completed? Come on, yes or no? Yes, sir. Which is 4,37,500. Now we are done with your inventory turnover ratio also. We are done with your GP margin also. And now they have told you quick ratio, that is 1:2. So can I calculate my quick ratio? Come on, yes or no? Yes, sir. So working note number 5. What is the formula for quick ratio? Guys, quick ratio actually means from current assets, you subtract stock, you subtract prepaid expenses, you divide that by current life. Do you have the quick ratio? Yes, sir. We have the quick ratio. How much is it? 1:1. So this is 1. And now what is the total of particular case? Can I say what should be my total of current assets? So this will now become 5,37,500. So now do I have my amount of the total current assets? Come on, yes or no? Yes, sir. Which is nothing but 5,37,500. Can I go and write down here 5,37,500? Come on, yes or no? Yes, sir. So this will now be 5,37,500. So this will now give me cash. So my cash will be balancing figure 5,37,500 minus 2,18,750 minus 4,37,500. So it now gives you 1,80,000. So this is now going to be my breakup of the current assets. I hope you all have understood this much part. Now, my dear students, after this, what is the next thing? Asset test ratio also we have considered. So I think now we have considered all the things. So the balancing figure here will be your plant and equipment. So what is going to be the balancing part? From 17,50,000, I will subtract 5,37,500. So this will be 12,12,500. And is this going to be my amount of the fixed assets? Come on, yes or no? Answer is absolutely yes. This is going to be 12,12,000. Okay, guys. So I hope you all have understood the entire question. How should we approach? Which all things we should take into consideration? How should we prepare the format? Which figures to start with first? And also, whatever working you have done, I just want you all to give the reference to those working notes also. So this was nothing but your long-term debt 5,50,000 from which came from working note number 1. Then we had your sales 43,75,000, but we are more importantly concerned with your debtors. The debtors is 2,18,750, which comes from working note number 3. Then, my dear students, the next thing which we had was your stock, which was nothing but 4,37,500, which came here, working note number 4. And as you all can see, that cash is nothing but balancing figure. Okay. So this is how we have solved the entire question. I hope you all have enjoyed this particular question. Extremely easy, manageable. Okay, but these type of questions do come in the examination. That's why I'm solving it in the class, and I also want you all to solve it properly. Okay. Chalo, great. Now, let us start with the next question. Okay, let us start with your question number 12. So let's do this question. Question number 12. Here also we are preparing the balance sheet. So actually I want you all to focus first on those questions in which we are required to prepare the balance sheet and all. So it becomes, you know, easier for you to understand it. Okay. So question number 12. Let's read this particular question. From the following information and ratios, we are required to prepare the balance sheet as at 31st of March 23 and the income statement for the year ended on that particular date of Messrs. Ganguly and Company. So we are required to prepare income statement and your balance sheet. So we have average stock, we have current ratio, we have acid test ratio, which is also known as a quick ratio. Then we have EBIT upon EBT. We have debt collection period, assume 360 days in a year. Then we have stock turnover ratio, use sales as turnover. Okay. So my dear students, here we are not going to calculate the stock turnover ratio based on COGS. Here we are required to calculate the stock turnover ratio based on sales. Okay. Then we have fixed assets. Then we have your working capital. We have net profit ratio. We have gross profit ratio. We have operating expenses excluding your interest element, long-term interest and the taxes nil. So first step is, here they have told you to prepare balance sheet and income statement. So here we are not going to prepare the ledger account. We are not going to prepare the account, but rather are we going to prepare the income statement? Come on, yes or no? Yes, sir. So you all can now go to your notebooks and write down. This is solution to question number 12. And here we can write down income statement. And in this income statement, now we are going to start with first of all sales less COGS. What do you get? GP. Normal standard practice. Sales less COGS, that will give you GP. From GP, then what are we subtracting? So we are subtracting something which is called as operating expenses. We are subtracting operating expenses. We will be getting EBIT. From this we subtract interest. What do we get? EBT. But this itself is your NPAT. Why your EBT itself is your NPAT? Because there is tax in this particular question. And also at the same time, can you see there is any preference share capital or something like that? Then the answer is absolutely no. So this entirely belongs to your equity shareholders. So the entire net profits belongs to your equity shareholders. Now, my dear students, what is the data which is given to you? First of all, let us just check. Ready data is average stock. No, sorry, average stock I cannot take it into consideration. Okay. Acha. We have the data which is pertaining to operating expenses, that is nothing but 9 lakhs. So at least I can write down here 9 lakhs. Okay. And now let us also prepare the face of the balance sheet. So you all can write down your balance sheet as on 31st of March 2023. So we'll be preparing this in the T format where there will be liabilities rupees, assets rupees. Now what are the list of liabilities which are possible? As you all can check here, there is no other data given to you regarding your preference shares, etc. So it is going to be only equity share capital. Then we also have reserves and surplus. The total of this actually gives you equity shareholders. And then after that, my dear students, do we have any debt? Any debt? Just check. Do we have any debt in this particular capital structure? See, if there is any long-term loan interest, so there has to be debt. So I'll write down your long-term loans. And then, my dear students, we'll simply write down the current liabilities. And then, my dear students, we are going to have assets. So what are the assets which we are going to have? So your fixed assets, so I'll directly write down fixed asset. There is no other breakup given to you. And then we are going to have current assets. So in your current assets, what is going to happen now? We have to search for data. Are we having in this particular question asset test ratio? It means definitely there is going to be current quick ratio, means current assets minus stock minus prepaid expenses. Upon current liabilities, it means what? That are we going to have any stock? Come on, yes or no? Yes, sir. We are definitely going to have stock. So in current assets, we'll be having stock. Then what is the next thing? After this, do we have data regarding your debtors? Come on, yes or no? Yes, sir. So there will be debtors as well. And then, my dear students, we have something which is called as your cash and bank, or we can also call this other current assets. So guys, as a standard practice, what are we going to do? How are we going to start? So the figure which was readily available, we have taken that into consideration. Okay. Now, what next? Guys, we have average stock which is available. As you all can see, we have average stock available. So now, if I have average stock available and if I have stock turnover ratio available, wow, can I calculate what is going to be the amount of my sales? Come on, yes or no? Of course, yes, we can calculate the amount of the sales. So what is going to be now? Your working note number 1. And in this working note number 1, I will write down calculation of sales. And how am I going to do this? This calculation of sales, I will take into consideration your stock turnover ratio. And what is the formula for stock turnover ratio? It is nothing but sales upon closing stock. Okay. Chalo, fine, no problem. If there is any other stock which is given to you here, no, but unfortunately there is no other stock which is available here. So we will treat this average is same as closing. And how much is this ratio? This ratio which is given to you, that is nothing but stock turnover ratio which is available, that is nothing but 5 times. So this is 5 times. Let the sales be X and the average stock appears to be 10 lakhs. So this is nothing but the amount of my sales. What should I do next? Can I go and substitute here in the income statement? Yes, sir. That is 50 lakhs. From this now, what are you going to subtract? So from your sales, my dear students, your GP ratio is given to you, that is 40%. So can I say 20 lakhs is your GP? 50 lakhs is your COGS. So will this give me my amount of EBIT? Come on, yes or no? Yes, sir. So that will be nothing but 11 lakhs. And then, my dear students, we have to subtract the amount of the interest. Now, how will you calculate the amount of the interest? Do you have any debt in the capital structure? No. Till now, we don't have it. Okay, but yes, chalo, there is 12% rate of interest, so we'll wait for it. Okay. So average stock is done, current ratio is done. Okay. Now I can actually use my quick ratio, but quick ratio is current, whatever is your current assets minus stock minus prepaid upon your current liabilities. Unfortunately, till now, I don't have the breakup available of anything. Okay, so I'm not going to do that. So my current ratio is also remaining. My asset test ratio is also remaining. EBIT upon EBT. Can I do EBIT upon EBT? Come on, yes or no? Of course, yes, I can do it. EBIT upon EBT. So what is this ratio? Working note number 2. Calculation of EBT and interest. Calculation of EBT and interest. So in this particular case, what is going to happen? We will simply take first whatever is the ratio which is given to you. So EBIT upon EBT is nothing but 2.2:1. Now out of this, do I have the amount of EBIT? Yes, sir, I do have it. So that is 11 lakhs. So if this is 11 lakhs, EBT. So that is going to be now 11 lakhs. Divide that by 2.2. So that will eventually give you 5 lakhs. So this will be your EBT amounting to rupees 5 lakhs. Which brings us to the conclusion that interest would have been 6 lakhs. Clear, guys? So now we are going to have the interest amount, which is nothing but your 6 lakh rupees. So we are actually done with the preparation of the entire income statement. Where we started with sales, we subtracted COGS, we got the GP. From that, we subtracted operating expenses, we got EBIT minus interest, EBT, and there is no tax in this question. Guys, if there is no tax, can I say all the profits are going to belong to your equity shareholders and all the NPBT itself is your NPAT. Okay. Now, your EBIT upon EBT is done. Now, so much of data is available. As you all can see, we have now the next ratio, which I can actually solve it can be, you can actually find out the amount of the long-term loans. As you all can see, the rate of interest is 12%. And do you have the amount of your interest available? Come on, yes or no? Yes, sir. What's the amount of the interest available? 6 lakhs. So can I say that working group number 1, calculation of okay, I think here we have already done working on number 1, working on number 2. Okay, so here we'll write down calculation of debt. Okay, calculation of debt. Now, what is the amount of the interest which we have got? We have got the amount of the interest as 6 lakhs and we know the rate. Okay, the rate is nothing but 12%. So for 100, if it is 12, so for 6 lakhs, it should be how much? That is going to be 50 lakhs. So are you going to have the amount of the debt which will be 50 lakhs? Come on, yes or no? Yes, sir. I can go now and substitute this, which we have actually got from working note number 2. We have amount of the debt, which is 50 lakhs. Now let's try to find out the nexus. We have now average collection period. So guys, in this particular question, we can also calculate your debtors because sales is already available. Okay. So now we will write down next point. Calculation of debtors. Calculation of debtors. Now, what is your debt collection period formula? It is nothing but 1252 or 365. In this particular case, they have told you to assume 360. Divide that by average debtors upon credit sales. But as you all are aware about this fact, guys, there is no opening debtors available. So this itself will now become your closing. So your debt collection period will turn out to be, one second, this is credit sales upon average debtors. So now this will become average debtors upon credit sales into 360. So this is now going to be your debt collection period, average debtors upon credit sales. And if opening is not available, we can write down this as closing. Do you have the amount of, do you have the debt collection period available? Yes or no? Yes, that is 30. So this is 30 is equal to, let this be X. And what is the amount of the sales which you have got? So your amount of the sales is nothing but 50 lakh rupees into 360. So 50 lakhs into 30, divide that by 360. So can I say that is nothing but 4 lakh 16,667. So what is this 4 lakh 16,667? That is nothing but the amount of the debtors which you have got. So I can substitute here 4 lakh 16,667. For stock turnover ratio, have we already calculated the amount of the stock? Uh, okay. So we are actually having the average stock available. All right. So we can now use your average stock actually to get the amount of your closing stock as well. Okay. See, how are we going to do this? Working note number 4. See, what is your stock turnover ratio? Usually it is COGS upon average stock. But in this particular question, they have told you to use sales. So it's sales upon average stock. And guys, do you have your stock turnover ratio available? Yes. How much is that? The stock turnover ratio is 5 times. So this will be 5 is equal to sales. Do I have the amount of the sales available? Yes, I got it here. No? The sales was nothing but 50 lakhs. Okay. And your average stock is nothing but 5 lakh, 10 lakhs. So what is your average stock? Opening plus closing divided by 2. So I have the average stock figure of 10 lakh. Okay. And in this question, have they mentioned to you that what is going to be your no other data is given to you. Okay, so we'll wait for the stock to be calculated. Okay, I think we can calculate the stock with the help of the asset test ratio, because for asset test ratio we have actually got the total of current. Have we got the total of current assets, current liabilities? No, we have the current ratio available. We have working capital available. So you know what we will do next? See, pay attention. I'll explain to you in the most easiest manner so that this becomes very easy. So let us now first, instead of stock turnover ratio, let us now first start with your current assets and current liabilities. See, what is the formula? The formula for working capital is CA minus CL. And do I have the current ratio available? Yes, sir. What's my current ratio? 3 is to 1. So my current ratio is CA upon CL, and that is nothing but 3 is to 1. Correct? So my CA is 3, my CL is 1. So working capital will automatically become 2. Okay. Do I have the amount of the working capital? Come on, yes or no? Yes, sir. That is 10 lakhs. So I have this as 10 lakhs. So can I find out my current assets total? Yes, sir. So that is 10 lakh into 3. Divide that by 2. So my current assets total is coming as 15 lakhs. And my current liability total is coming as 5 lakhs. So now we are in a very comfortable situation. We have the current assets, which is 15 lakhs, and we have the current liabilities, which is nothing but 5 lakhs. So my CA total will be 15 lakhs and my CL total was nothing but 5 lakhs. My CL total is 5 lakhs. Now see, this data will actually help me to now calculate what should be the amount of the stock. Why am I telling you this is because, as you all are aware about the fact that to calculate the stock, now I will use your quick ratio. Now, what's the formula for quick ratio? It is current assets minus stock minus prepaid upon your current liabilities. So what's your quick ratio? Your quick ratio is 1:1. So this is 1 is equal to my total of current assets is 15 lakhs. Let the stock be X, prepaid is 0 and the current liability is 5 lakhs. So my stock will come as 10 lakh rupees. So this will be the value of the stock. So as what we have written here also, average stock is same as your closing stock. Here automatically the stock was given to you 10 lakhs and based on this we got the stock amount as 10 lakhs. So I'll substitute here 10 lakhs. But I just reconfirm that by applying your asset test ratio. So now what is this figure going to be? This will be 10 lakh plus 4 lakh 16,667. From this I will subtract 15 lakhs. So this apparently comes as 83,333. So this will be your cash bank, 83,333. Now, my dear students, we are done with current ratio also, asset test ratio also, EBIT upon EBIT also, debt also, debtors also, stock turnover ratio also. Let's calculate now fixed assets turnover ratio. So this will actually help you to calculate the amount of the fixed assets. So working note number 6. For every figure I'm preparing working note so that you all don't face any problem while solving. While revising, notes should be comprehensive, it should be sufficient for you. So what's the formula for fixed assets turnover ratio? Your fixed assets turnover ratio is sales upon fixed assets. So what's the turnover ratio? Just check. The turnover ratio is nothing but 0.8. Do I have the amount of the sales? Yes, sir. We got the amount of the sales, which was nothing but 50 lakhs. So what should be the amount of the fixed assets? So my amount of fixed assets will now be 62 lakh 50,000. So this will now be 62 lakh 50,000, which will be now my fixed assets. So I can write down here 62 lakh 50,000. With this, at least I know I have 77 lakh 50,000 as my balance sheet asset side total. This is also 77 lakh 50,000. From which if I subtract 55 lakhs, what will I get is 22 lakh 50,000, which is actually my equity shareholders funds. So working capital is also done, CA minus CL, then net profit ratio. We had actually used for this particular part calculation. So your net profit ratio is also done. GP is also done. Operating expenses, 9 lakhs, that's also we have written. Long-term interest and tax. So now we are only left with your equity shareholders funds and there is no breakup of share capital and reserves given to you. So we will keep it as it is. So this is how your final calculations will be done. So I hope my dear students, you all have understood this entire concept, okay, about how do we prepare the income statement and the balance sheet. Okay. Let us start with question number 14. Now in this question number 14, we are required to prepare the income statement and we are required to calculate these ratios. But here, my dear students, they have specified it is something which is called as dividend yield ratio. Now, what is dividend yield ratio? See, yield in finance always means returns. Okay. So whenever we are required to calculate your dividend yield ratio, yield means we are required to calculate your returns. So how do we calculate the same? We take into consideration whatever is your DPS and we divide that by MPS into 100. So that's how we calculate your dividend yield ratio. Okay, so understand a situation like this. When I tell you that market price of equity share is 50 rupees and the company is declaring a dividend of 5 rupees. So what is the returns which you are generating? So can I put it like this? You are actually investing a share for 50 rupees and you are getting a dividend of 5 rupees. Can I say the total return is nothing but 10%? Come on, yes or no? Yes. The returns is 10%. So whatever is your yield or returns can be calculated by taking simply whatever is going to be your DPS, and with that DPS you will be multiplying that by, you will be dividing that by market price per share. So that is going to give you your final figure. Okay. So always remember like this, my dear students, whenever we are required to calculate your dividend yield, how will you do it? We will take DPS, divide that by FPS. Okay, if I ask you what is the formula for earning yield, then what is going to be your answer? Sir, earning yield will be nothing but EPS upon MPS into 100. So everywhere, wherever you try to calculate the returns, what you need to do is, we have to simply take dividend per share or earning per share and divide that by market price per share into 100. So that eventually gives you what is going to be the yield, or that is going to be the return. Now, the capital structure of beta is as follows, in which there is equity share capital, which is 8 lakhs and the face value is rupees 10. So these are number of equity shares 80,000. 9% preference share capital. It is 3 lakhs of preference share capital and rate is 9%. It means that now the dividend, can I say the dividend will be nothing but 27,000? This is preference dividend. This is not equity dividend. The preference dividend is 3 lakhs multiplied by 9%. So that's nothing but 27,000. When the total of this is 11 lakhs, additional information in which there is profits after tax at the rate of 35%, which is 2,70,000. So we have NPAT available. Then, my dear students, we have depreciation of 60,000. Then we have equity dividend paid, which is 20%. So that is actually going to be your 20% on the face value. So 10 rupees is the face value. On that, 20% will be your dividend. Market price per share is 40 rupees. You are required to compute the following. Show the necessary workings, dividend yield on equity shares. The first thing you have to calculate is, what is the dividend yield on equity shares? So dividend yield on equity shares can very easily be calculated by taking DPS upon MPS into 100. Yield means returns. So we need market price per share, we need dividend per share. And whenever we are talking about dividend yield, what type of the dividend we are talking about? Is it equity preference both, or it's only equity? Answer, it's only equity. Okay. So dividend yield only deals with your equity dividend and not your preference dividend at all. Okay. Then, my dear students, we have cover for preference and equity dividend. Hello. We have discussed this in some other important ratios. There was something which is called as your preference dividend coverage ratio and equity dividend coverage ratio. Now, what is the coverage ratio? Once again, I'll quickly revise this for you. Coverage ratio actually means the number of times your fixed obligation is getting covered. So if suppose your let's say interest coverage ratio, suppose your interest is 1 lakh rupees and your amount of EBIT is 10 lakhs. So can I say your interest is getting covered 10 times? Come on, yes or no? Yes, sir. So coverage ratio actually means what? From the amount of your EBIT, you divide that by interest. So first we need to check that what is the fixed obligation and from where are we making the payment. Of course, if you are talking about interest coverage ratio, your interest is actually paid from your amount of EBIT. So what do we need to do? We have to simply take the EBIT and divide that by interest to get something which is called as your interest coverage ratio. If I tell you, let's calculate preference dividend coverage ratio. How will you calculate your preference dividend coverage ratio? You will take your NPAT, divide that by your preference dividend. That will give you preference dividend coverage ratio. So always remember like this, that whenever we have to calculate your coverage, we need to check from where this particular amount is paid. Equity dividend coverage ratio. Equity dividend coverage ratio, guys, from where are we making payment of the equity dividends? We are making the payment from net profits for equity shareholders. So we take net profit for equity shareholders and we divide that by equity dividend. That will give you your equity dividend coverage ratio. Okay. Then we are required to calculate earning per share. We have discussed what is earning per share. The profits available for equity shareholders, we divide that by number of equity shares. What we get is the earning per share. And your P ratio is nothing but whatever is going to be your MPS, from that you will be dividing that by EPS. And if you all can recollect, your P ratio indicated what? It indicated the willingness of an equity shareholder to pay for earning 1 rupee of EPS. So how much is he willing to pay more? Okay. So that's why we have something which is called as a price earning ratio. Okay. Where we take into consideration MPS upon EPS. Now, my dear students, based on this particular part, we are now required to actually prepare the income statement first, and then we will be calculating these different types of ratios. So everyone along with me will now go to your notebooks and write down. This is now your solution to question number 14. Yes, sir. So first write down income statement. So how will we start with the income statement? We will be starting with, first of all, sales. But here, guys, I don't think we require all those things. We have already NPAT available. Okay, so what we will do is, instead of preparing the income statement from sales, we know that NPAT minus preference dividend. Will this give you net profit for equity shareholders? Yes, sir. From this, if I subtract my equity dividend, what will I get? Something which is called as your retained earnings. Do you all agree with this? We will call this as your retained earnings. So what is the amount of the NPAT which we have? The amount of the NPAT, the amount of the NPAT which we have is 2,70,000. So we have this amount as 2,70,000. What is the amount of the preference dividend? So as you guys can just check, for preference dividend, the dividend is 27,000. So I'll write down here 27,000. So from 2,70,000, if I subtract 27,000, what will I get? I will get 2,43,000. And what is my equity dividend? So equity dividend is 20%, 20% always of the face value. So the total face value which we have is nothing but 8 lakhs. On that 8 lakhs, I just need to multiply it by 20%. So 8 lakhs multiplied that by 20%. Now this will be 1,60,000. So 2,43,000 minus 1,63,000. So this will be 83,000. I hope you all are convinced with this income statement format. Okay. Now, my dear students, continuing this further, they have actually told you what should be your dividend yield on the equity shares. So what is going to be your dividend? So my dear students, your dividend yield is nothing but DPS by MPS into 100. Is this nothing but your dividend yield? Come on, yes or no? Yes, sir. DPS upon MPS into 100. So what is your dividend per share? Your dividend per share is nothing but equity dividend, divide that by number of equity shares. So we are now having equity dividend, divide that by number of equity shares, we get something which is called as dividend per share. So what is the equity dividend which we have? 1,60,000. What are the number of equity shares? The number of equity shares which we have is 80,000. So then in that particular case, this will become rupees 2. So we have dividend per share of 2. And what is the market price per share? So as you all can see that the market price per share is 40. So this data is sufficient for you to divide by 40 into 100. So that will be nothing but 5%. So this is the return. This is the yield. So whenever someone talks to you about the yield in financial management, always remember that this yield is nothing but the returns which we are generating. So these returns are actually calculated by taking DPS upon MPS. Whatever is your dividend, you divide that by the market price per share into 100. That is going to give you a dividend. Okay, are you guys trying to understand this? So DPS upon MPS into 100. So that will now give you your dividend ratio. What's the second part of the question? In the second part of the question, what is required to be calculated? Just check this out. We are required to calculate cover for preference and equity dividend. So what should be your preference dividend coverage ratio? And we are required to calculate equity dividend coverage ratio. So I've already explained you this. Coverage means how many number of times it is getting covered from the amount of the NPAT. So what we need to simply do is as you all know that preference dividend is paid from the N. So that's why the preference dividend coverage ratio will be NPAT upon your preference dividend. And what is your equity dividend coverage ratio? From where are we paying this equity dividend? We are paying it from net profits for equity shareholders. Excuse me. So this will now be net profit for equity shareholders, which we divide that by equity dividend. So do I have the amount of the NPAT available? Come on, yes or no? Yes, sir. We do have the amount of the NPAT. So what is the amount of the NPAT which we have? 2,70,000. From that, we are paying the preference dividend of 27,000. So now we'll be taking 2,70,000 upon 27,000. So this will give you 10 times. Now from where are we making the payment of equity dividend? So we are going to have your net profit for equity shareholders. Your net profit for equity shareholders is 2,43,000. And this 2,43,000, hello Rohit, we are going to divide that by equity dividend, which is 1,60,000. Okay. I'm so happy that one celebrity has joined right now. Okay. So 2,43,000, divide that by, we have 2,43,000, we are going to divide that by 1,60,000. So this will be nothing but 1.51875. I hope you guys are trying to understand this. Okay. You got my reply, Mr. Celebrity? Okay. Okay. Yes, better you can ask. So now we have preference dividend coverage ratio also, and we have your equity dividend coverage ratio as well. Now what is going to be the next thing? Third part. Your third part is what is going to be now earning per share. How will you calculate your earning per share? So this earning per share will be calculated by taking net profit for equity shareholders, divide that by number of equity shares. Okay. So now, my dear students, we are required to now calculate what is going to be your earning per share. So for that, what is the net profit for equity shareholders? So your net profit for equity shareholders will now be taken into consideration. Whatever is the net profit for equity shareholders, just check this out. Your net profit for equity shareholders is nothing but 2,43,000. So we are going to take 2,43,000 and we will be dividing that by number of equity shares. So what is the number of equity shares which will be taken into consideration? So your number of equity shares will now be, it's given to you in the question. The number of equity shares is nothing but 80,000. Okay. So 2,43,000, if I divide that by 80,000, so this will eventually give you rupees 3.0375. So now we also have the earning per share available, and that earning per share is nothing but 3.0375. So we have your EPS also available, and also at the same time, my dear students, we have the preference dividend coverage ratio, your equity dividend coverage ratio, everything else we have calculated. So now we are in the position to calculate the last part, and the last part is nothing but your P ratio. So how do you calculate the P ratio? The P ratio is nothing but MPS upon EPS. So what is your MPS? Just check. Your market price per share is 40 rupees and your earning per share is 3.0375. So how many number of times? So we will take 40 and we'll be dividing that by 3.0375. So this will eventually give you 13.17 times. So this is how we will be taking into consideration what is going to be your P ratio. So is your P ratio coming as 13.17 times? Yes. So equity shareholders are willing to pay how much number of times? Are they willing to pay 13.17 times for 1 rupee of the EPS? Come on, yes or no? Then the answer is absolutely yes. Okay, so this is how we have to take it into consideration. Okay, now we are done with your question number 14. Okay, so now let's continue further with the next question, which will be your, we are done with 14th part, right? So let us now start with the next question, which is your question number 7. Okay. So don't worry, question number 7, okay, looks lengthy, but very much manageable. Okay. See what is given to you in question number 7. Following information are available for Navia along with its various ratio relevant to the particular industry it belongs to. Appraise your comments on the strength and weaknesses of Navia, comparing its ratio as compared to the given industry norms. So what we are going to do in this particular question, we are going to take into consideration whatever is going to be your ratios of the company and compare that with the industry. So ratios of the company, we are going to compare that with the industry standards, and that's how we'll be getting the final answer. Okay. So ratios, are we going to compare with the industries? Come on, yes or no? Yes, sir. What is given to you that first of all, balance sheet, we are having equity share capital, which is 48 lakhs. Then we have 10% debentures, 9 crore 20 lakhs. Then we are having, so it is not 9 crore 20 lakhs, better, this is 9 lakh 20,000. Okay. This is 9 lakh 20. And then we are having sundry creditors, bills payable, and other current liabilities. Okay. We just check this out. Yes. So this is 9 lakh 20. Then on the asset side, we have fixed assets, cash, debtors, stock, all those things are available. We have statement of profitability for the year ended 31st March 2020, in which there is sales, less COGS. We are now having materials, wages, factory overheads. Then we are having gross profit, less selling and distribution overheads, administrative overheads. We are having EBIT, from which now we are going to subtract your interest. We'll be getting EBT, from that we'll be subtracting tax, we'll be getting NPAT. Okay. So these are the industry norms. So you know what we need to do? For Navia Limited Limit, we are going to calculate the current ratio, the debtors turnover ratio, etc. based on whatever is the data, whatever is the income statement and balance sheet which is given to you. And then we are going to compare that with industry to analyze whether Navia Limited is doing good or bad. Okay, so this is what we are going to do in this particular question. So I just want you all to please go to your notebooks and now write down solution to question number 7. Okay. And in this question number 7, you have to write down calculation of ratios. So how are we going to calculate the ratios, guys? To calculate the ratios now, we will be taking into consideration particulars, Navya, when we are having industry standards, and then we'll write down your analysis. Okay. So the first ratio which we actually have is your current ratio. So we are having current ratio. What's the formula for current ratios? As you all know, current ratio is nothing but current assets which will divide it by current liabilities. So do you have Navya Limited current assets? Yes, sir, we do have current assets. Current assets will be the combination of cash, debtors, and stock, right? So we'll be taking into consideration cash plus debtors plus stock, and then we'll be dividing that by the current liabilities. Okay. So this will be other current liabilities. So what is your cash? 8 lakh 80, 11 lakh, and 33 lakhs. 11 lakhs and 33 lakhs. And this, my dear students, will be dividing it with what? Current liabilities. So what are the other current liabilities which we have? 4 lakh 40. So what is your total of current assets? 52 lakh 80, which will divide that by 4 lakh 40. So this will be 12. Acha, other current liabilities also, current liabilities also has all this part. So current liabilities will also be the combination of creditors, bills payable, plus other current liabilities. That's what I was wondering, that how can we have such big amount of your current liabilities? So what is the amount of the creditors? 6 lakh 60. Bills payable is 8 lakh 80. And your other, if I divide that by 19 lakh 80,000, so this will now be 2.67. So your current ratio should be 2.67 is to 1. And what is the industry average ratio? Your industry average ratio is 2.5. So what does it mean? That is the company having a current ratio which is higher than the industry standard? Come on, yes or no? Yes, sir. So that is going to be our analysis. Company has higher current ratio as compared to industry. So company is going to have a higher current ratio as compared to the industry. Very simple logic, beta. 2.67 and then 2.5 times. So company has a higher current ratio as compared to the industry. Now, second part. What is the second ratio? What have they told you? Receivables turnover ratio. Guys, can I say this is nothing but debtors turnover ratio? So what's the formula for your debtors turnover ratio? We take your credit sales and we divide that by your average debtors. But your opening is not given to you, so we're going to take closing only. And do we have sales? Yes, sir. 1 crore 10 lakhs. Are we going to assume the entire sales are on credit basis? Yes, sir. And what is the amount of the debtors? You have the amount of the debtors, which is nothing but 11 lakhs. So I will simply take 1 crore 10 lakhs. Okay. So I should write down the formula here. Credit sales upon average debtors. But instead of average, we'll be just using the word closing debtors. What is the amount of the credit sales which I have? 1 crore 10 lakhs. And with this 1 crore 10 lakhs, I will now divide it by the closing debtors, which appears to be 11 lakhs. So 1 crore 10 lakhs divided by 11 lakhs will now give you 10 times. What is now going to be your industry average debtors turnover ratio? So your industry average debtors turnover ratio is 8 times. So what does it indicate? Is the company performing better than the industry? Come on, yes or no? Yes, sir. So what is going to be your conclusion here? Company has higher turnover ratio as compared to industry, which indicates which indicates better performance. Which indicates what, beta? This indicates better performance. So this is nothing but your debtors turnover ratio. Next part, third. What is the third part? Your inventory turnover ratio based on sales. So now we are having stock turnover ratio. So what's the formula for stock turnover ratio? As you all know, your stock turnover ratio is nothing but COGS upon average stock. But here we are going to take sales upon average stock. Okay, because they have specifically told you based on sales. So do I have my sales available? Yes, sir. What's my sales? 1 crore 10 lakhs. And what is the average stock? Can I say average stock will be nothing but here the closing stock itself, and we have the closing stock available as 33 lakhs. So this will be 33 lakhs. So this will now give you 1 crore 10 lakhs divided by 33 lakhs, which will give me 3.33 times. Don't forget to check this with the help of your industry turnover ratio. So your industry turnover ratio is nothing but 9 times. Oh my God. So in this particular case, can I say that the company has a turnover ratio which is less than the industry? So that is a mark of inefficiency. So we will write down here, company has a lower, company has a lower turnover ratio as compared to industry, indicating inefficiency. Can I say this indicates inefficiency? Come on, yes or no? Yes, sir. There is inefficiency. Then fourth part. What is the fourth part? Your total asset turnover ratio. Now, as you all are aware, what is the formula for total asset turnover ratio? It will be sales upon total assets. So do we have your sales? Yes, sir, we do have the amount of sales, which is 1 crore 10 lakhs. And what is your total assets? So guys, in your balance sheet, we have the total assets of 77 lakhs. So what is this ratio? Let's check this out. 1 crore 10 lakhs divided by 77 lakhs. So this will be 1.43 is to 1.43 times. So this is your total asset turnover ratio, which is 1.43 times. Let's check this out with the industry. Your industry asset turnover ratio is how much? So that is 2 times. Okay. So here also, can I say the company is performing inefficiently, because all this should be higher the better. But the company is having a turnover ratio which is lower than the industry standards. So can I say that this is not good? This is a mark of inefficiency. Come on, yes or no? Yes, sir. So we'll write down, company is inefficient as compared to industry with respect to asset turnover ratio. So it means that the company is not performing efficiently. So there is inefficiency here. Then fifth part. What is the fifth ratio? This is net profit ratio. So what's the formula for net profit ratio? Guys, the formula for net profit ratio will be very simple. NPAT upon sales into 100. Come on, you all know this. Do we have the amount of the NPAT? Come on, yes or no? Yes, sir, we do have the amount of the NPAT. Just check. NPAT is 2,31,000. And sales is nothing but 1 crore 10 lakhs. So this will be 2,31,000. Divide that by 1 crore 10 lakhs into 100. So this will not be nothing but 2.1%. Let's check the industry. Oh, industry has a net profit ratio of 3.5%. So can I say company is inefficient as compared to the industry? Why? Because company is having a net profit ratio which is actually lower as compared to the industry standards. Okay. So what are we going to write down here? Company has a lower net profit ratio as compared to industry. And guys, all this is the outcome of what? That the company is having lower efficiency. The company is actually having a lower asset turnover ratio. So all these things will be definitely reflected somewhere. So where is it getting reflected? In the net profit ratio. And what is happening to the net profit ratio? The company's net profit ratio is lower as compared to the industry standards. Let's talk about the next ratio. Your next ratio which we have is your return on total assets. So what's going to be your return on total assets? So the formula for this is very simple. See, whenever you want to calculate returns, we take profits in the numerator and then we take the assets in the denominator. So we are going to take NPAT in the numerator and we are going to divide that by total assets. So what is your NPAT? Just check. Your NPAT which is available is 2,31,000. What's the total assets which we have? The total assets available here is, if you just check this out, 77 lakhs into 100. So 2,31,000, divide that by 77 lakhs into 100. So that comes out to be 3%. And now, my dear students, if this comes out to be 3%, what is going to be your industry? Your industry return is 7%. So again, the same analysis. Company is inefficient as compared to the industry. Company is inefficient as compared to industry. Okay. Then, my dear students, we have the next point, and that will be nothing but return on net worth. So how do you calculate your return on net worth? As we have discussed, net worth is nothing but what? It is equity shareholders funds. So if you actually want to calculate your return on net worth, how will you do that? You will simply take your net profits for equity shareholders, which will divide that by equity shareholders funds, which is also a net worth, into 100. So guys, do you have the net profits for equity shareholders? Yes, we do have it. 2,31,000. Do we have the net worth also available? Yes or no? Yes, sir. We do have it, the net worth. The net worth is nothing but equity share capital plus reserves. There is no reserves. So it's 48 lakhs. So this will now be 2,31,000. Divide that by 48 lakhs into 100. So it's 4.81%. Let's check about the company. The company has a very handsome 10.5% return on net worth. So what is going to be your conclusion, guys? The conclusion here is going to be that the company's efficiency is bad as compared to the industry. Okay. So we can just write down here, company is inefficient as compared to industry. Okay. Then continuing further, eighth, which is the eighth ratio. So many ratios are there. The last one is total debt to total assets. We are going to have total debt upon total assets. So what is your total debt? Your total debt is nothing but, you guys can just check. We have the debt available as 9,20,000. And what is the total assets? So we have the total assets also available here, which is 77 lakhs. So eventually 9,20,000 divide that by 77 lakhs. So this into 100 will be 11.95%, and industry average is nothing but 60%. Now, my dear students, here I would like to differ. Why? Because industry standard tells you that for 100 rupees of asset, 60 rupees is your debt. And here our calculation tells us that for 100 rupees of your assets, we have a debt of only 11.95%. I hope you guys are trying to understand that our company has a lower debt proportion as compared to the industry. So is it good or it is bad? It is definitely good. So we'll write down, company has a lower debt to asset ratio, which means risk element is lower. Risk element is lower. So this particular Navia Limited, when we are comparing that with industry, we all are able to judge this, that Navia Limited, when we are comparing with the industry, we know that, okay, there is inefficiency. Also at the same time, there is, apart from inefficiency, then there is drop in the return ratios. Some of the profitability ratios are getting affected. But yes, company has a good capital structure. Their debt as compared to the total assets is relatively lower as compared to the industry standards. Okay. So this is how, my dear students, we solve your question number 7. Okay. So I hope, my dear students, you have understood. Now in 1 to 7, 6th is left. Then 7, 8 is done, 9 is done, 10 is done, 11th is left. Okay. 12 is done, 13th is left. 14 is done, 15th and 16th. Okay. So these are all little bit smaller questions. Okay. But some of the questions in this also, it is little bit higher, question number 11. Okay. That will take little bit of time for you to complete it. So I hope, my dear students, we have enjoyed what we have done today. Okay. The lecture was only solving of questions, because one theory part is over. We are just left with application of these particular concepts. And as I'm telling you, my way of teaching is very, very, very conceptual. First, we'll be doing the concepts, then we'll be starting with the practical problems. In practical problems also, we are solving each and every question step by step. Okay. Though it's going to take time, but the ratio analysis, what you are going to do, it's going to be the best amongst all. So don't worry about it. Okay. So with this, my dear students, we are going to now put an end to today's stream. Tomorrow, we will be having, tomorrow and Sunday, 2 days will not be having any lecture. But yes, definitely we'll be having lecture now on next Monday. So Monday we'll be having the lecture. Okay. So we'll continue on Monday. I hope you guys have understood this. So that's it from my end. Bye guys. Take care. See you. I'll now see you on the next lecture. That will be on Monday. Take care. Bye.